One of these stocks trades at 42 times book value. Another one has no PE ratio at all, because you can't divide by a number the market has already stopped caring about. And in the last 2 trading days, all 3 of them fell off a cliff. This is not a story about whether AI is real. AI is real. This is a story about the gap between a real theme and the price people are willing to pay for it. Because right now in Japan, 3 stocks have turned AI data centers and hyperscaler spending into a permission slip to ignore valuation entirely. Let me show you the numbers. Then you decide what they mean. Quick note before we start, this is data analysis, not investment advice. Nothing here is a recommendation to buy or sell anything. Do your own research. Let's get into it. We start with the most extreme one, Kioxia, ticker 285A, market cap 59 trillion yen. That's top tier among all Japanese companies. A giant. Now, here's where it gets strange. The price-to-earnings ratio? Not high, not low. It doesn't compute. Return on equity? Also not calculable. And price-to-book sits at 42.4. 42 times what the company is actually worth on paper. So what's holding this up? Retail euphoria, and you can measure it. On June 12th, short interest sat around 720,000 shares. Margin buying? Over 11 million shares. By late June, still above 10 million. That is an enormous pile of individual investors buying on borrowed money. And it has been sitting there, stacked up, for weeks. Where did the rocket fuel come from? Back on May 15th, Kioxia reported earnings that roughly doubled and beat expectations, a second straight record year. That triggered a limit-up move. Then came reports of next-generation memory samples shipping for AI servers. Then a report that the CEO was about to announce a stock split. Each headline added another stage to the rocket. The stock briefly punched through 100,000 yen. And then gravity showed up. On July 2nd, down 13.5%. The next day, July 3rd, down another 13.5%. In 2 days, a huge chunk of the euphoria unwound. That's not a wobble. That's the market rechecking its own math. Now the one that should surprise you the most. Fujikura, ticker 5,803. Fujikura makes cable, wire. This is a traditional, 100-plus-year-old electrical company. The kind of stock that is supposed to be boring. And right now it trades at 14 times book value and 34 times earnings. Historically expensive for a company in this business. To be fair, its return on equity is genuinely strong, 40.8%. This is not a company with nothing behind it. But look at the positioning. On June 12th, short interest was around 1.46 million shares. Margin buying? Over 28 million shares. The ratio of long to short margin positions was nearly 20 to 1. 20 to 1. That is a crowd all leaning on the exact same side of the boat. The catalyst. After the close on June 18th, Fujikura raised guidance. Recurring profit up 45%. A new record forecast. Orders for optical components from U.S. hyperscalers were climbing, and prices were rising with them. The market loved it. June 19th and 22nd, 2 straight limit-up days where the stock literally couldn't find sellers. And then the reversal. July 2nd, down almost 8% in a single session. The boat tipped. Third one, Furukawa Electric, ticker 5801. And this one teaches a different lesson. Market cap, 3.7 trillion yen. PE of 45.8. Price to book of 9. Return on equity of 19.6%. Solid, but nowhere near enough to justify those multiples on its own. So why is it here? Because Furukawa didn't fully rise on its own story. It rose on Fujikura's story. Look at the timeline. On May 12th, Furukawa posted its own strong earnings. Profit up 32%, a dividend hike, and hit a limit up. Fine. But then, on June 19th, when Fujikura dropped its blockbuster guidance, Furukawa jumped 15%, a limit up, dragged straight up in sympathy. That's the tell. When a stock goes vertical mostly because a different stock reported good news, the buying isn't about fundamentals anymore. It's about momentum. And momentum cuts both ways. Just 3 days later, June 22nd, Furukawa fell more than 15%. After a 10-for-1 stock split, it dropped again on July 2nd, down 8.6%, up 15 on someone else's news, down 15 on the way back. That's what a sympathy trade looks like when the music stops. So step back. What do these three have in common? Every single one of them wraps a real theme: AI data centers, hyperscaler capex, optical components, around a set of historically abnormal valuation numbers. And in every case, the same fuel is underneath: a massive stack of individual investors buying on margin, treating the theme as a reason to stop asking what the business actually earns. That's the structure. A real story is being used as a permission slip. It's AI, so the PE doesn't matter. It's hyperscaler, so book value doesn't matter. The theme is true. The pricing is where the risk lives. Here's the uncomfortable part, and I want to be precise about it. A high valuation is not a prediction. It doesn't tell you when anything happens, or even that it has to. Plenty of expensive stocks stay expensive or grow into their price. What extreme multiples plus crowded margin positioning do tell you is something narrower, that expectations are stretched, and that the crowd is positioned one way. When almost everyone is leaning long on borrowed money, there's very little fuel left to push higher, and a lot of fuel to accelerate the fall. You saw exactly that on July 2nd and 3rd. That's not a forecast. That's just what the data describes. On this channel, that's the whole job. Separate the narrative from the numbers. Not to tell you the story is fake. Often it isn't. But to show you what you're actually paying for it. If you want the next one, I'm building a screen that flags this exact setup across the entire Tokyo market: extreme multiples plus crowded margin buying. Subscribe if you want to see which names show up next. And one more time, because it matters. This is data analysis, not investment advice. Nothing here is a recommendation. Do your own research and manage your own risk. I'll see you in the next one.